Hello, everybody, and welcome to episode 1 of the Agency Profit Lab podcast. I'm your host, Eli Clark, founder of One Bridge Accounting, and I'm super excited to have you on the show today. Whether you're listening in on Apple Music or Spotify or wherever that might be, or you're watching on YouTube, welcome. Excited to have you for this inaugural episode, the very first one. I'm excited about this. We're going to talk about five financial metrics that agencies need to track, and they're metrics that are actually going to help you in managing your business, managing your finances. So let's jump right in. Let's do this. So most agencies, in my experience, are either tracking a ton of metrics or they're tracking nothing at all. It's like one or the other, right? And there's some issues with this, of course, right? If you're tracking too much, that's information overload, it's decision paralysis. You don't know what is important to pay attention to, what is important for you to really see, what's actually going to give you a view into your business, into your agency, what's actually going on. And then if you don't track at all, then you're driving a blind car, right? You're navigating without a GPS, you're navigating without a map, without a compass, without any sort of direction about where you need to go. So there's problems on both sides of that. Either you're tracking too much or you're not tracking enough. And then there's the issue of tracking the wrong metrics. Track the wrong metrics, you're going to make the wrong decisions, right? Because you're not getting the information that you need. In general, simplicity is going to lead to clarity and growth. So that's what we're going to talk about today. 5 main metrics that you want to track that are going to help you no matter where you're at in your stage of your business. So let's talk about the first one. The first one is net profit margin. Now, we'll go through the formulas of all of these, and I'll kind of talk to you about what those formulas mean, why they're important, and a couple of tips that are going to help you in your agency. So first one, again, net profit margin. So net profit margin is found by taking the net profit, dividing that by total revenue, and then we multiply that by 100 in order to get a percentage. So net profit is our revenue minus all of our expenses. So net profit is also sometimes called net income. So net profit, net income, kind of the same thing, and then total revenue is just all money coming into the business. So let's talk about an example. If you're doing, let's say, $300,000 a year in revenue, and you have $240,000 worth of expenses. So if we take $300,000, we subtract $240,000 from it, that leaves us with $60,000 in net profit or net income. If I take that $60,000, divide that by total revenue, multiply it by 100, that gives me 20%. So my net profit margin in this example is 20%. Now, what does that even mean, right? Like you say 20%, it's like, okay, well, what does that actually quantify, or what insight does that give us into running an agency? What insight does that give us into running our business? What decisions can we make with that, right? So net profit margin shows you for every dollar in revenue that you're generating, how much of that dollar is going to go to profit, is going to go to actually in your pocket money that you're going to keep. So 20% of a dollar would be 20 cents. So for every dollar in revenue that you make with a 20% net margin, then you're going to pocket 20 cents. Now that might not sound like a lot, because it kind of isn't. You know, for every dollar that you make, you only get 20 cents in your pocket as far as profitability. You're like, well, it's like, we could do better than that. And generally agencies do. Usually a healthy target for you to reach is somewhere between 30 and 50% for most agencies. I've seen some agencies do as high as 70%, just depending on what kind of services you offer and how much it costs you to deliver those services. So those are all kind of different factors when it comes to what is a healthy margin for you in your business. And that's going to change as your business develops, as it ages, as you figure out more and more about the finances of your business and what's going on. You're going to understand what a healthy target is for you. But just out of the gate, 30 to 50% is generally pretty good for most agencies, no matter what kind of services you're offering, whether that's SEO or public relations, or you're just doing web design. 30 to 50%, generally what you can expect and what you can kind of shoot for. If you're not hitting that 30 to 50%, then there's a couple of things that you want to tweak with your business. So a couple of tips. One is you can raise your prices. If we look at that equation, net profit divided by total revenue, two of the factors there is net profit and total revenue. So if we want to increase our net margin, we can raise our prices without increasing the amount that it costs us to deliver the services, right? So you charge more for the same type of work or for the same amount of work. So the costs don't go up. So that's an important thing when it comes to raising your margin, is that your prices go up, but the cost to provide the service doesn't go up. So that's one thing that you can do to raise your net profit margin. Second thing you can do is you can lower your costs. So you've got two different kinds of costs within agencies. You've got variable costs, which are typically project costs. So if I have, for example, an SEO service that I'm providing to a client for $3,500 a month or $5,000 a month, whatever that number is, what does it cost me to deliver that service? Let's say it costs me $2,000, right? And if I can get that number lower, so instead of it costing me $2,000, it costs me $1,500, overall, my project costs have gone down. You can also look at your overhead. So overhead is fixed costs that stay the same month to month, year to year. These are things like salary that's not related to projects. So if you're paying yourself a set amount every single month, or if you have a software that you're paying for, let's say you're paying $800 a month for HubSpot, no matter how much money you make, HubSpot is still $800 a month, right? So you can work on lowering those costs, or you can work on raising your prices, or a combination of both. And that's how you're going to increase your net profit margin. That's an important number for you to look at. And that is number one of the five numbers that we're going to look at today. So net profit margin, again, tells the real story of your business health. It tells you what's going on. You want that margin to be as big as possible. And that's really, again, the number one indicator of what is going on and what is happening in your business. Is your business healthy? Let's talk about number two, gross profit margin. Now, you might think that those are very similar, and they are. So you've got net profit margin and you have gross profit margin. Net profit margin is revenue minus all of your costs, the margin of that percentage. So 20%, 30%, usually a lower number. Gross profit margin, the formula for that is revenue minus the cost of delivery of the services that you're offering, or the cost of your services. So a good example to think about this, or a simple example, is with a website. Let's say you're charging a client $3,500 a month, $3,500 for a website, and it costs you $1,000 to build that website. So we just go revenue, $3,500 minus the cost to build that website, which is $1,000. And then we divide that by the revenue, $3,500, to get 0.71. So 71% gross profit margin. A gross profit margin shows you how efficient you are at delivering the work. So whereas a net profit margin just shows you how healthy your business is in general, it shows you how profitable you are, how much money you have at the end of the day for every dollar in revenue that you generate. A gross profit margin tells you how efficient you are at generating sales, at generating revenue, delivering the work that you sold, delivering the work that is your revenue. So a healthy target that you want to shoot for with a gross profit margin is usually 50 to 70% with marketing firms. So in the example that I shared, $3,500 a month $3,500 for a project. It costs you $1,000 to build that. That's a 71% gross margin. That's pretty good. And in fact, it's really great. Generally what you're going to find for marketing firms. Now, let's say you're doing SEO services. You're charging $5,000 a month, and it costs you $2,500 a month to deliver those services, whether you're using a white label SEO provider or you're using an internal team and all the costs associated with that team fulfilling the work. You've got a 50% gross profit margin. So again, anywhere between that 50 to 70% gross profit margin is pretty good. Tip here. Here's my suggestion. I don't see a lot of marketing firms doing this because it's a lot of work, and you have to do a lot of setup with software and things like that, but it's super valuable and it's actually quite easy once you do have it set up. If you're using, an accounting system like QuickBooks Online, my tip is to use some sort of a project management software where you can assign, or where your team members can clock in to specific tasks or projects or clients. That way you know that, okay, I'm charging $5,000 a month for SEO for client A, and I have, this contractor, and this contractor all clocking in under this project, and I know what it costs me for them to do that work, right? So use a project management tool that allows you to see what costs are per project or per client or per service. Ideally, all three would be really nice, but then you can see and look at all of those different areas of your business and what your gross profit margin is. If you're under 50% gross profit margin, a couple of things for you to think about is you're either underpricing, so you're not pricing enough for the work that you're doing. You're over-delivering, so you're doing too much work for what you're charging, or you're inefficient. The costs of doing the work are more than they should be. So those are the three things you want to look at if your gross profit margin is under 50%. You're either underpricing, you're over-delivering, or you're not being efficient enough in delivering the service. So gross profit margin, great number to look at, great way for you to see how profitable you are. The money that is left over after your gross profit margin is what goes to pay for your overhead costs or your fixed costs. And then whatever is left over after your fixed costs is your net profit margin, right? So it kind of all goes down in a line together. Okay, number 3 metric that you want to look at, you want to track on a regular basis. Average revenue per client. This is a pretty simple calculation as well. And look at your total revenue, divide that by your total number of clients. What this does is going to show you how much money each client is worth to you on average. Kind of similar to lifetime value, or LTV, very common metric that is used. This is a little bit different, but is very similar. This is kind of more of an annual basis of LTV, if you know what LTV is. So when you have a high average revenue per client, it means you have fewer clients. Whereas if you have a lower average revenue per client, you generally have a lot more clients and there's just a lot more work that you need to do for the amount of revenue that you're generating. So for example, let's say you're generating $240,000 a year in revenue and you have 8 clients. That means per year, each one of your clients is bringing in, on average, $30,000 a year. That's pretty good. That's pretty great, depending on what kind of services you're offering. Generally, it's easier to manage 8 clients and to do the work for 8 clients than it is to do the work of 20 clients or the work of 50 clients. What we want to do is we're looking at becoming more profitable as an agency, is we want to look for the clients that have more painful problems. And what I mean by that is, you take client A and client B, and let's say they both have the same issue. They both need SEO services. Maybe they're a roofing company and they get most of their leads through SEO. One of your clients, say client A, has other channels that they use to generate clients. So SEO is not that big of a deal for them. It's not as big of a way for them to attract clients, to get leads, right? And let's say you take client B where they don't have that marketing funnel set up. So SEO is a huge thing for them. It's very, very important. You can do the same work for 2 different clients, and those 2 different clients can value that work differently. What you want to do as an agency is you want to find more of client B and less of client A's, because client B has a more painful issue. They have a more painful problem that you're able to solve for them. And that issue being finding clients, right? Finding leads. So you want to, instead of chasing new clients, work on upselling bigger services to your existing clients and weeding out the clients that don't value your services as much, right? What that allows you to do is it allows you to have fewer clients, less stress, bigger profits. Everybody's happier all around. So average revenue per client, important number for you to look at overall to see how much your clients are worth on an annual basis. And it's a great number to use in conjunction with lifetime value, or LTV. Okay, let's talk about number 4. Number 4, client retention rate. So this formula is you look at the clients at the end of a period, let's say a year or a month or a quarter, and we divide that by the clients at the start of that same period, and then we multiply it by 100 to get a percentage. So what this number does is it shows you how good you are at keeping your clients long term. It is so much easier to hold on to a client and to build a great relationship with that client than it is to try and find new ones constantly. And so it's important that you look at what are we doing to build relationships with the current base of clients that you have, as long as they're the clients that you want, right? And what are you doing to help build relationships with them long term and to build multi-year relationships for the long term, right? So an example of this formula, let's say you start with 10 clients at the beginning of 2025 or any year. And at the end of the year, at the end of 2025, you only have 8 clients anymore. So we're going to take the clients at the end, 8, divide that by the clients at the start, 10. That gives us an 80% retention rate, which is not too bad. Generally, you want to shoot for around 80 to 90% retention. 100% is ideal, but obviously some clients aren't going to stay around a long time. So 80 to 90% is what you want to shoot for, anything above that. If it's below 70%, I'd be a little bit concerned. I'd want you to look at, okay, what are we doing that maybe is turning clients away? Are we not delivering on our promises? Like we say, hey, we're gonna deliver you these results, and you don't deliver those results. You need to look at fulfillment. You need to think about, okay, how can we better make sure that we're first off tracking the results that we're promising clients that we're going to give them, and that we're actually delivering on those results, right? So it could be increasing technical knowledge, it could be increasing accountability. There's different things that you might want to look at there. It could be maybe clients don't feel appreciated. Maybe that's one that's super important, right? Think about, maybe do I send a client a gift when they first come on board? Do I remember important things like the client's birthday or certain holidays, stuff like that, right? These are all different ways that you can increase client retention is through kind of some of those customer service elements. Another thing that you can do to increase your client retention rate is to offer services that naturally renew on a regular basis, whether that's monthly or quarterly. So a good example of these types of services is like SEO, ads, whether that's PPC or social media ads, and content that you create. So maybe you do video editing, or you help them run their podcast, or you create blog articles for them, whatever that is, right? So those types of services that renew naturally on a kind of a regular basis makes those clients sticky, right? It makes them want to stay around a little bit longer. So that's a good thing for you to look at, as well as, maybe lean into some more of those recurring services and pair those with one-off projects like web design every now and then. But if you're wanting to improve your client retention rate, wanting to get MMR, monthly recurring revenue, or annual recurring revenue, then it makes sense to offer services that renew on a regular basis. Okay, last one for today, number 5. I want you to look at cash reserves. Now this one is, you're not going to track this one as actively as some of those other numbers like net profit margin or gross profit margin or client retention rate. But this is still a very important number, and one that I see a lot of marketing agencies not tracking. And I think this is such an important number because it helps you to prepare, one, for emergencies, for things that just come up. Let's say the economy is in a downturn, or you have a client that leaves. Having cash reserves is really important to building up your business for the long term and making sure you can survive on a long-term basis. So this formula is the cash on hand divided by your monthly expenses. So that's going to tell you how many months you can survive with the cash that you have on hand. Without any additional new sales. So for example, let's say you have $90,000 in the bank and it costs you $30,000 a month to run your agency. So 90,000 divided by 30,000 is 3. So 3 months is what you have in cash reserves. Now that might sound like a lot, but in an economic downturn, 2 to 3 months is going to go by very quickly. If you can't generate new sales in 2 to 3 months, or maybe you lose clients, or that type of thing, then you're going to have to start doing things like letting go of staff, or you're going to have to stop paying yourself, or those types of things in order to keep your business afloat. So to help kind of prevent any sort of those issues that can occur in economic downturns, or that can occur if a client leaves, I recommend at least 2 to 3 months of cash reserve in your business. And then again, just to figure that out, you just look at what your monthly expenses are. In our example, it's $30,000 a month. For 3 months, then you want at least $90,000 in kind of an emergency fund or a cash reserve that you're going to keep on hand. Now, if you are a little bit more cautious, maybe you want to feel a little bit more peace of mind when it comes to your finances, then you can shoot for 4 to 6 months. Now, 4 to 6 months of cash is a lot of cash, right? So if you don't have that on hand, don't feel like, that you're not prepared in an emergency. But 4 to 6 months is just going to give you more peace of mind than just 2 to 3 months will. Cash is going to give you the breathing room, and it's going to help you make better decisions under pressure when you're not worried about, am I going to make payroll for this month because we don't have sales anymore, or am I going to be able to afford to pay your mortgage, right? Your personal mortgage, because you can't pay yourself anymore just because of the expenses of the business and economic downturn. So recommend 2 to 3 months, ideally 4 to 6 if you have that cash on hand. Now, where do you keep this money, right? Do you keep it just in your business bank account? Normally, I wouldn't suggest that. Normally, I would suggest that you put it in something called a high yield savings account. Or you can put it into U.S. Treasury bonds. So let's talk about first high yield savings account. So high yield savings account is through a normal bank, and what they do is they offer you a higher percentage. Usually it's 4.5% or 5% on the money that is in your bank account. And what that allows it to do is to keep up with inflation. It's not an investment account where you're going to make a ton of money. That's not the goal of it, but the goal is to help keep up with inflation, and so that it's not losing money just sitting in a bank account. So high yield saving account is generally what I recommend. It keeps your money really accessible, so you could just withdraw it anytime that you need it, again, in a case of emergency. You can also do this with some types of bonds and other types of investment portfolios. I generally recommend, if you're going to do this, look at more like U.S. government treasury bonds, because that's going to help, the U.S. government is generally pretty stable. It's one of the most stable economies and governments in the world, so you're going to get generally a good percentage, and again, it's going to keep up with inflation. You're not going to get rich from that strategy, but it's more of a way for you to protect yourself in the case of issues or problems that arise, again, in the economy, or you lose a client or something like that. So there we go. There's 5 agency metrics that I would recommend that you track that are going to be helpful for you. So again, that's net profit margin. What that number does is it tells you for every dollar in sales, how much of that you're going to keep as profit. You have gross profit margin, which tells you how efficient you are at delivering the work, getting the work done. Average revenue per client, that shows you how much money each client is worth on average on an annual basis or a monthly basis. You can do that however you'd like. Client retention rate shows you how good you are at keeping your clients long term. And then last but not least, cash reserves, which shows you how many months you could survive without new sales. So those are my 5 metrics that I would recommend that you track on a regular basis for your agency. So if you found this content valuable, please let me know. Put a comment below, subscribe, follow us for more. And if you have any questions, please feel free to reach out to me.